What if the ability to multiply your money wasn't a secret held by a privileged few, but a skill, a language that anyone with the discipline to learn could master? For generations, the complex world of active trading was a fortress, its gates guarded by the titans of Wall Street. The average person could only peer over the walls, told that the safest path was to simply hand their money over and hope for the best. But the world has changed. In the last decade, a new wave of financial mentors has emerged, not from the marble halls of investment banks, but from the digital town squares of our modern world. They have taken the once arcane language of the markets and translated it for a global audience, proving to millions that the power to build substantial wealth is not a matter of birthright, but of education. They have demonstrated that by understanding the underlying rhythm of the markets, anyone can learn to move from a position of financial uncertainty to one of command and control. Today, we embark on a journey to understand the core principles of this modern approach to wealth creation. We will distill the essence of this new school of thought into 3 foundational steps, designed not for gambling or reckless speculation, but for the intelligent multiplication of your capital. This is a framework built upon 2 unshakable pillars: the art and science of technical analysis and the ironclad discipline of risk management. It is a pathway to transforming yourself from a passive saver into an active, informed architect of your own financial destiny. If you are ready to begin this transformation and acquire a skill set that can serve you for a lifetime, show your commitment by giving this video a like, and let us take the first step together. Let us first address the most significant barrier that stands between an aspiring trader and success: the wall of intimidation that is a stock chart. Many intelligent investors have mastered the art of fundamental analysis. They can dissect a company's balance sheet, analyze its income statement, and project its future earnings with confidence. This is a valuable and necessary skill. But when presented with a chart covered in lines, bars, and indicators, they often feel a sense of profound overwhelm. It appears to be a chaotic, indecipherable code. The first principle to embrace on this journey is a simple one: the chart tells a story. Every candle, every price swing, every surge in volume is a sentence in a larger narrative about the battle between buyers and sellers, between fear and greed. In the beginning, this story will be difficult to read. The first 30 days of looking at charts will likely feel confusing, even frustrating. This is a normal and expected part of the learning process. But something remarkable happens through consistent daily immersion. The human brain is a pattern recognition machine. After 60 or 90 days of dedicated observation, the chaos begins to resolve into clarity. Patterns that were once invisible will start to emerge. You will begin to instinctively recognize the structure of price movements and the significance of candlestick formations. This is the moment when the language of the chart begins to make sense. And this skill is the key to mastering your entries into the market. One of the most common and costly errors in investing is emotional buying. It is the act of purchasing a stock at the peak of a speculative frenzy, driven by an intense fear of missing out on further gains. This is not investing, it is gambling on momentum. Technical analysis serves as a powerful antidote to this destructive impulse. It provides a logical, evidence-based framework for decision-making. It offers a map of the financial landscape, highlighting strategic, high-probability areas to enter a position based not on the noise of the crowd, but on the clear, observable data of the chart itself. A core element of this disciplined, technical approach lies not just in what you buy, but how you buy it. The novice trader, driven by excitement, often makes the critical mistake of deploying their entire capital for a trade in a single transaction. They go all in, hoping for an immediate upward move. This approach, however, is a recipe for emotional turmoil. A single adverse move in the stock can trigger a panic response, leading to a premature and often costly exit. The seasoned strategist, by contrast, understands the power of scaling into a position. This means that you never commit your full intended investment at once. Instead, you enter with a smaller, initial starter position at a key technical level you have identified. This single act fundamentally changes the psychological dynamic of the trade. If the stock immediately moves in your favor, you are participating in the gains. But more importantly, if the stock pulls back, it is no longer a moment of panic. It becomes a strategic opportunity. By keeping a significant portion of your capital as dry powder, you have the ability to add to your position at more advantageous, lower prices. This method allows you to methodically build a full position, often at a much better average cost than if you had gone all in at the start. This is one of the most effective techniques for mastering the emotional side of trading. When you know that a market dip is not a threat but a potential advantage, you are liberated from the grip of fear. This disciplined entry strategy allows you to withstand the market's natural volatility, giving your investment thesis the time it needs to play out and ultimately achieve its potential return. This is how you begin to see the chart not as a series of random fear-inducing events, but as a structured dialogue between buyers and sellers that you can learn to interpret and act upon with calm authority. Learning to interpret a stock chart is akin to a grand master learning to read a chessboard. At first, one sees only individual pieces. With experience, one begins to see the entire strategic landscape, the patterns of attack and defense, and the probable future moves. This is the art of pattern recognition. It is the ability to look at the flow of candlesticks and instantly identify key battlegrounds, levels of support where the buying army has previously held the line, and levels of resistance where the selling army has historically mounted a strong defense. A decisive break through one of these levels is a significant piece of intelligence, signaling a potential shift in the balance of power. To aid in this analysis, disciplined traders rely on a small set of powerful indicators, not as a crystal ball, but as a compass to help them navigate the market's flow. While there are countless options, a common and effective combination focuses on defining the trend. This often includes a trio of exponential moving averages. A short-term average, such as a 13-period EMA, acts as a sensitive gauge of immediate momentum. A medium-term average, like a 48-period EMA, provides a smoother, more stable view of the intermediate trend. And a long-term 200-period moving average serves as the ultimate line in the sand, often defining the boundary between a major bull market and a bear market. For traders focused on shorter time frames, these are often paired with the volume-weighted average price, or VWAP. Think of the VWAP as the true price of a stock throughout the day, as it takes into account not just the price, but the volume of shares traded at each price. It reveals where the majority of the day's business has been conducted. These tools are not magic. Their purpose is to help a trader objectively answer one of the most important questions in the market. What is the dominant trend? The old saying, "the trend is your friend," is a cornerstone of profitable trading, but these indicators give that phrase a concrete visual meaning. When a stock is trading above these key moving averages, the path of least resistance is generally upwards. This is a tailwind for your bullish trades. Conversely, when it is trading below them, the prevailing winds are bearish, offering opportunities for those who understand how to profit from downward moves. Trading in harmony with the dominant trend is a fundamental principle that dramatically increases the probability of success. At this point, it is vital to draw a clear line between two distinct disciplines: long-term investing and active trading. For the vast majority of individuals, the most reliable and time-tested path to building significant wealth is through passive, long-term investing. Owning a diversified, low-cost index fund that mirrors the S&P 500 is the financial bedrock upon which a secure retirement should be built. Decades of market history have proven that this simple strategy will outperform the majority of active traders. This should always be the foundation. However, for those with a greater appetite for risk and a willingness to dedicate significant time to education and practice, active trading represents an opportunity to pursue accelerated returns. This is the pursuit of alpha, the excess return above and beyond the market average. This is typically done with a smaller, segregated portion of one's capital, money that is specifically allocated for this higher risk, higher potential reward activity. Interestingly, the skills of a long-term investor can provide a powerful edge in the trading arena. Consider an investor who has owned a blue-chip stock for many years. Through simple observation, they may notice a recurring, almost seasonal pattern in its price behavior. They have seen the stock find support at a certain level and rally to a predictable resistance point year after year. This deep familiarity can provide the conviction needed to use more sophisticated trading tools, such as options, to capitalize on these expected moves. A well-timed call option can amplify the returns of a stock's upward move, potentially generating in months what the underlying stock might take years to achieve. This is the power of using trading to supercharge a portfolio's growth. But this power must be wielded with an absolute and unwavering commitment to the second pillar of our framework, risk management. This is the element that separates professional traders from amateur gamblers. It is a multifaceted discipline. It begins with the non-negotiable use of stop-loss orders to define your maximum acceptable loss on any single trade. It continues with the discipline of taking profits, systematically converting a winning position on paper into realized cash in your account. And it is rooted in a deep and honest understanding of your own psychology. Before you ever place a trade, you must know your personal pain threshold. You must define in precise dollar terms the amount you are willing to lose and have the fortitude to honor that decision without hesitation. Mastering risk is not just a part of the game, it is the entire game. So, what is the practical, day-to-day process that allows a trader to operate with this level of discipline? It begins with a philosophy of depth over breadth. The amateur trader is a hunter, constantly chasing the hot stock of the day, flitting from one unfamiliar name to another. This is a reactive and often disastrous approach. The professional, in contrast, is a specialist. They cultivate a small, manageable watch list of stocks that they come to know with an almost intimate familiarity. They understand their unique personalities, their typical volatility, and how they behave at key market junctions. The true work of a trading week does not begin on Monday morning. It begins on Friday afternoon, after the market has closed and the strategic analysis can begin. The disciplined trader will review their small universe of stocks and identify the single one or two that present the most clear and high probability technical setup for the week ahead. The entire weekend then becomes a period of deep, focused study. This is not a casual glance at a chart. It is a meticulous process of mapping out every critical support and resistance level. It is the formulation of a detailed if this, then that trading plan. Every potential scenario is anticipated and rehearsed. If the stock opens higher on Monday, there is a predefined plan. If it opens lower, there is a different, equally well-defined plan. If it trades sideways, there is a plan for that as well. The goal is to eliminate all guesswork and emotional decision-making from the live trading environment. The critical strategic thinking is done in the calm and quiet of the weekend, so that during the heat of the market session, the trader is not thinking. They are simply executing a plan they have already built and committed to. This level of preparation is what transforms trading from a game of chance into a business of probabilities. It is this unseen, methodical work that allows for calm and decisive action when opportunities present themselves. If you are beginning to appreciate the profound level of preparation that goes into professional trading, let me know by typing "Preparation is power" in the comments below. It is this very dedication that separates consistent success from random luck. This brings us to the third and final step in this journey, a step that represents the pinnacle of financial mastery. After you have dedicated the months and years to acquiring this skill set, after you have honed your discipline and achieved a level of consistent success, you undergo a fundamental transformation. You cease to be merely a participant in the market. You become a source of genuine, provable expertise. In our modern information-driven economy, this level of specialized knowledge is an incredibly rare and valuable asset in itself. The most influential financial educators of our era have demonstrated a powerful and ethical model for leveraging this expertise to build not just personal wealth, but a thriving community and a sustainable business. This model is not built on aggressive sales tactics, but on a foundation of authentic value. It unfolds in three distinct stages. First, they establish a deep well of trust. They do this through relentless consistency, showing up day after day, sharing their insights openly and transparently. Second, they operate from a mindset of abundance, providing an extraordinary amount of high-quality, actionable education for free. They prove their worth and demonstrate the effectiveness of their methods long before ever asking for anything in return. They understand a profound principle. A community built upon the genuine success of its members becomes the most powerful and organic marketing force imaginable. And third, only after that foundation of trust and value has been firmly established, they offer a pathway for the most dedicated members of their community to engage on a deeper, more intimate level, typically through a premium private group. This is a model that rejects scarcity and embraces the idea that the more knowledge you share, the more success you create for others, and the more that ultimately returns to you. The path we have outlined today is therefore one of profound personal and financial evolution. It begins with the humble decision to learn a new language, the language of the markets. It progresses through the disciplined daily practice of technical analysis and ironclad risk management. And it can culminate in a state of mastery that not only grants you the power to multiply your own capital, but also the ability to create immense value for a community of fellow learners. This, in its truest sense, is the ultimate form of financial freedom. If this framework has provided you with a clear and actionable roadmap for your own financial journey, support our channel by subscribing and share this video with one person you believe needs to hear this empowering message. The road to multiplying your money is not a short or easy one, but it is a road paved with principles of discipline and education, and it is open to anyone who has the courage to begin the journey.